Hello folks, Steve Lentz here with Discover Options here at Option View. Welcome to this presentation of several market timing reports for the S&P 500 for advanced options traders. This will be for Friday, October 13th, getting ready for Monday, October 16th, 2017. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Folks, we have three reports for advanced options traders. The SPX Condor Butterfly Timing Report that answers the question, is now a good time to implement a Condor or Butterfly campaign? We have a Bull Put Spread Timing Report for the SPX that answers the question, is now a good time to put on a Bull Put Spread in the SPX 30 days out, roughly, with the short strikes, a standard deviation away or so. The third report is the Directional Likelihood Report that answers the question, based upon past incidences of the current market condition, what is the S&P 500 likely to do? Go up, move down, or wobble around for a bit? Okay? Before we get to those, please hit the subscribe button. That way you'll get notified when we come out with new videos. Also, we have the ebook that's available for you. If you click the link, give us your information. We'll get this free ebook out to you, co-authored by myself and Jim Graham. Simple Steps to Options Trading Success. The current market condition, as you can see, we've had a just tremendous amount of congestion and choppiness over the last week. We define it in three ways: price action, trend, and then the stochastic condition. And so price action, you can kind of barely see that Thursday's bar was actually an upswing bar. The high was actually a little bit higher than Wednesday's, just by a little bit, qualifying it as an upswing bar. Friday was also an upswing bar as well. So we have two consecutive upswing bars above the 50-day simple moving average, with the stochastic between 70 and 100. And it's in an uptrend. And you know that little, it says, it's actually not below. I'm going to rewrite that. It is above the 3-period simple moving average, or %D. There you go. Okay, so this condition is really quite common. It's very common, as we'll see in just a little bit. Let's go to the first report, the Condor Butterfly Timing Report. So since Jan of 2000, we've had roughly 4,491 closes of the SPX. Now, of those, 65.7% have been favorable bars for selling option premium through butters and condors, because the actual 21 bar movement, okay, in 65.7%, the actual 21 bar subsequent movement was less than what was being implied by the SIBO skew adjusted VIX. Okay, so that's 65.7 were favorable. You could flip a coin and come up 65.7% of the time, you would have chosen a favorable bar for selling premium through butters and condors. Now, also during that time, our current market condition that I just described, okay, occurred, including consecutive occurrences, including those 498. It occurred 498 times. That's a lot. Now, of those 498 occurrences, 71.5% of those were similarly favorable for selling premium through butters and condors. Now, that implies an edge of 5.8% or so. So statistically, it's more likely than usual that our current market condition will end up being favorable for market-neutral option premium selling, such as through butters and condors, okay? So that's the Condor and Butterfly Timing Report. Let's go to the Bull Put Spread. For those of you that like to do similar strategies where you're selling premium but perhaps bend them bullish, maybe you're selling puts, a standard deviation out 30 days away, this is the report for you. So also, since Jan of 2000, we've had 4,491 closes of the SPX. Now, of those, all right, 83.1% were favorable for selling those puts a standard deviation out 30 days away, where the actual 21 bar downside movement was less than what was being implied by the SIBO skew adjusted VIX to the downside. Okay, so that says that you can take all 4,491 occurrences, flip a coin on all of them, and you know what? 83.1% of the time, you're going to catch a bar where the downside movement will not hit that put strike 30 days out, a standard deviation away. Okay, where you won't touch that, in other words. Okay, so our market condition has occurred 498 times, like I previously said. Now, of those 498 times, okay, 86.3% of the bars, of those bars, were similarly favorable for selling put option premium standard deviation away 30 days out. Okay, so that implies an edge, a premium selling edge, a put premium selling edge of 3.2%. So statistically, it's more likely than usual that the market condition on Friday will end up being favorable for selling out of the money put premium. Okay, it's more likely than usual that it will be favorable. That's what we're saying here. More likely than usual. Okay, so that's the bull put spread timing report for those of you that like to trade that way. It's a great way to trade. Great way to trade. Let's now go to the market likelihood report. Here we are answering the question based upon past occurrences of the current market condition. What is the market likely to do? Go up, down, or wobble around for a bit. Now, to answer that, we use price distribution bands. We use 6 of them. And let me just show you a little picture here. This is the 5-day bands, and we have a band set to the upside and the downside, as you'll see here on the far right. And we set these a standard deviation out, but I'm using the skew adjusted VIX. So you have the close, and you have the upside 5-day band, a standard deviation out. You have the downside band, a standard deviation out. Now notice that the upside band is closer to the close than the downside band. And that's because the out-of-the-money calls have a lower implied volatility than the out-of-the-money puts. So we adjust those for the skew, and this is reflective of what the options market is predicting. So for each of these closes, we track where the market eventually in 5 days went up and hit the upper band, the lower band, or didn't hit either one of them. And we keep those statistics for every close going back. We keep these statistics not only for the 5-day band, but also the 10-day band and the 15-day bands as well, both to the upside and the downside. So when we come to this report, take a look at the very top. Over the 4,491 times, okay, that we've had a close on the SPX, okay, 5 days from that close, the upper band got struck 21.4% of the time. The upper 10-day band, 15.9%. The upper 15-day band, 14.8%. On the downside, the lower band got struck 16.5%, 16.7%, 19.5%. So that's the benchmark out of the entire history of the SPX trading since Jan of 2000. Now, our current market condition, non-consecutive occurrences, 274 non-consecutive occurrences, unique occurrences, okay? Of those 274, let's just look at those. The upper band was struck 8.8% of the time. That's far less than the 21.4 on the benchmark for the whole history. So this gives us a big, big indication that the upper band is much less likely to get struck after our current market condition than just the basic market in general over the course of the history of the SPX. The same holds true with the upper 10. Look at that, 8.4. The upper 15-day band, 9.5. All 3 upper bands far less likely to get struck. On the downside, similarly, the amounts are far less than what the benchmarks are. Okay? And so we can see, again, all 3 downside bands are getting struck less often. See, that is a picture, folks, of lower market volatility. A pretty dramatic picture of lower market volatility. So, keep that in mind moving forward. Now, that we're not really seeing a directional bias here that much. The lower bands are getting struck a little bit more often, but not much. If you had to bend a direction, you could say, well, the lower bands are struck a little bit more often than the upper bands. But, you know, across the board, all 6 are getting struck less often. So it's more likely than normal that we're going to see lower market volatility in the next 5, 10, and 15 days. Is it a guarantee? Well, certainly not. You could see 8, 9, 10% of the time the market did move and hit those bands. Okay, but that's far less than normal. I think you get the picture. Now, what I like to do, just to give us a hint a little bit, is ask, what happens if price goes above Friday's high? What is the price distribution in the past when Friday's high is exceeded in this market condition? That's occurred 172 times. Of those 172 times, 5 of the 6 bands were struck less often, as you can see here. Again, a picture of lower market volatility. If the low from Friday gets exceeded, here again you can see all 6 bands were struck less often. You see that? Okay, a very blatant picture of lower market volatility is what's likely coming our way. So, with that, now it's not guaranteed, of course. You can see 10, 15% of the time they did get struck, but that's way less than normal. So, with that said, let's close it up. Thanks so much for joining us. Here we go. Let me click out. There we go. Oh, timeout. There we go. Folks, I'm Steve Lentz with Discover Options. Thanks so much for joining us. We'll see you next week. Bye-bye.